Hello and welcome to this short video where in the guides section we're going to have a look at the financial strength requirements of banks and building societies since the banking crisis. New regulation has been brought in and every bank and building society has to produce a Pillar 3 report which looks at their risk-weighted assets exposure, their minimum capital requirements and their Tier 1 capital leverage ratio. So let's have a look at the risk-weighted assets first and foremost. Quite simply, the bank and building society has to disclose the assets that they hold, i.e. the types of organisations they lend money to. Now, and in this situation, we have, as an example, two banks. One has lent out £100 million to AAA rated organisations and one has lent £100 million out to CCC rated organisations. Now clearly in this example, the bank that's lent the money out to CCC rated organisations has a greater risk exposure than the one that's lent all of their money out to AAA rated organisations, and therefore the second bank will have to hold more capital in reserve, and the amount that they need to hold in reserve is 8% of Tier 1 and Tier 2. Tier 1 has to make up the main basis, i.e. Tier 1 capital is capital that's more accessible than Tier 2, and but the overall amount is 8%. Now clearly that's the minimum capital requirements. Banks and building societies work to that as a minimum, but they all have their own reserves in place, and some banks and building societies have reserves that are more than 5 times the amount required as a minimum. Now clearly in this scenario, a bank or building society that has 5 times the minimum capital requirements in reserve is safer than a bank or building society that only has the minimum 8% requirements. That's a very simple way of understanding how the capital reserves help to support the performance of a bank or building society. The leverage ratio, Tier 1 leverage ratio, this is the amount of Tier 1 capital measured against their overall assets, and again this as a regulatory requirement has to be a minimum of 3%. Again, banks and building societies will what they have will vary from this, but the higher the percentage, the better the rating for the bank or building society. And then finally, inside the system, we've split these ratings out so that if you have a client who has a large amount of money and you need to go over the FSCS license, or even if you have a client that doesn't have the protection of the FSCS license, then that's when the financial strength ratio becomes more significant. Prior to this, the Financial Services Compensation Scheme is by far the better form of protection. So there's a quick introduction. Hope you found that interesting, but if you need any more information then please do not hesitate to contact us.